If you can say clearly who uses financial accounts, who uses management accounts, and what cost accounting adds, you already understand a big part of what a management accountant actually does and what exam questions are really asking. Let's start with financial accounting. In management accounting, we describe financial accounting systems as the part of the business that carefully records assets and liabilities and reports profit and past performance to people outside the organization like shareholders and tax authorities. Assets are what the business owns of value, like cash or equipment. Liabilities are what it owes, like bank loans. Financial accounting's job is to capture these correctly and then produce formal reports so external stakeholders, such as regulators and interest groups, can see how the business has performed. Think of financial reports like an annual health check sent out to anyone interested in the company's overall financial condition. Shareholders, customers, suppliers, regulatory bodies, and even employees rely on these external accounts to judge stability and performance. Because these reports go to the outside world, limited liability companies are legally required to produce them in a set format. That format is controlled by local law and also by international rules like International Accounting Standards and International Financial Reporting Standards. Financial accounts give a big picture view of the whole organization. They are mainly about money amounts and they look backward, summarizing performance over a defined past period and showing the financial position at the end of that period. Now compare that with management accounting. Management accounting systems are built to give managers inside the organization the information they need, often using tools like corporate performance management software and business intelligence tools to pull together data that supports decisions. Unlike financial accounts, management accounts are prepared for internal use only. They are for managers at different levels, not for shareholders or regulators, and there is no law telling managers exactly how these internal reports must look. This lack of legal prescription gives managers a lot of freedom. They can design the format of management accounts in whatever way is most useful, instead of following a fixed template. The goal is usefulness for decisions, not compliance with a reporting standard. Management accounts can zoom in on detail that financial accounts do not show. They might focus on a single product line, a service, a department, or a specific activity, so managers can see which parts of the business are working well and which need attention. They also are not limited to money measures. Management accounts can include non-monetary information such as units produced, machine hours used, or other physical measures. This helps managers connect operational performance to financial results. Another key difference is the time focus. Management accounts look backward as a record of past performance, but they also look forward as a tool for planning and decision-making. So they support both control of what has happened and choices about what should happen next. Within management accounting, cost accounting is a specialist area. Cost accounting focuses on collecting and measuring cost data, including estimates for new and existing products, the cost of inventory, and the cost and profitability of different products and services. Cost accounting information is used for several practical purposes. It helps determine the cost of goods and services, evaluate the profitability of departments and the whole organization, set selling prices by referring to costs and value inventories for the statement of financial position. It is also vital for planning and control. Cost information is used to estimate future costs when preparing budgets and later to compare actual costs with those budgeted. That comparison feeds into budgetary control and variance analysis, highlighting where performance differs from plan. These cost systems are not just for factories. They apply to manufacturing services, government, and non-profit organizations, and inside a manufacturing business. Cost accounting should cover production plus other areas like administration, selling and distribution, and research and development. Let's apply these ideas to a typical multiple-choice exam question about management accounts. Imagine the question gives 3 statements. One says there is a legal requirement to prepare management accounts, another says their format is largely determined by law, and a third says they are only for future planning and not used as a historical record. From what we have just learned, we know there is no legal requirement to produce management accounts, and managers are free to design their format. We also know management accounts record past performance as well as support future planning. So each of the 3 statements in the question is wrong, and the correct answer is the option that says none of the statements is correct. So remember, financial accounting serves external users and is tightly regulated. Management accounting serves internal managers and is flexible. And forward-looking and cost accounting is the management accounting toolkit focused on costs and profitability. Keep asking in every topic who the information is for, and you will read exam questions much more clearly. If this helped, subscribe for more straight-to-the-point management accounting lessons.